This all leads us to our talk of the tape. After a 4-month rally based on a Goldilocks economy, AI excitement, and the prospect of an easier Fed, is the playbook changing as the first quarter winds down? Let's ask Adam Parke, Trivariate Research founder and CEO and a CNBC contributor. So, Adam, yeah, those have been the narrative threads. It's worked pretty well. Been almost no pullbacks. Been a little attention on some frothy pockets in the market. In the last couple of weeks, things have cooled off but not fallen apart. Where does that leave us?
Well, I think the bull case is still intact, right? If the average company can have gross margin expansion, if I start thinking earnings are going to be up for the next few years, they'll be ahead 25 versus 24. And if I ultimately think the Fed's going to be accommodative, I think that's a pretty good three-legged stool for optimism.
Yeah.
So the things I'm monitoring, I guess, to get cautious, three things. Does China continue to look bad, not improve? The fundamentals erode, the U.S. companies with exposure there look bad. Maybe I've gotten positive data points on a relative basis lately, but we'll see. U.S. consumer, does that really slow? I was worried about it when Discover reported, then they got bought. Then, there's been some pockets at the subprime we get worried, but I'd say in aggregate, the consumer's in pretty good shape, even if it's eroding a little. And the third thing is maybe you don't worry about the front end with the Fed, you worry about quantitative tightening and sort of the balance sheet. But that's how I'm weighing it, and it's still skewed to the positive as far as I can see it in terms of risk-taking.
So does that mean also on a tactical basis you would just kind of stick with what has gotten us here? I mean, you have seen things, for example, I mentioned the frothy pockets. I mean, crypto had this huge ramp. Everything related to it, it's backed off a little bit. So you've seen a few little hints that the market is sort of saying enough for now on some of the hot stuff. But what about tactically?
Most of my clients are institutional investors trying to beat the S&P 500, so they're never going to be too big in Bitcoin miners or uranium or whatever. I think they are focused on how to play AI, and so to me, that trend isn't in the price over a 3 to 5 or 10-year view. It may be a little ahead of itself tactically. So for me, I think there's lots of stuff to own. If you're going to say, hey, this is going to last 3, 4, 5 more months, there's fear of missing out, and I don't want to I'll run toward the bubble as opposed to away from it, then you still want exposure to AI semis, to software where revenue's accelerating. And if you want to balance it, which is what we do, we offered a note this week, 5 ways to find stuff that's not correlated to the AI trade in semiconductors, or maybe you own some energy and copper where, as you pointed out in your preamble there, crude's up a little bit. So I think there's ways to balance the portfolio, but I don't think you want to run a fund and say, I don't own anything related to AI. That doesn't seem right to me.
Yeah, arguably, that's kind of what the market in aggregate is doing in a way, right? It's not quite as all in on one trade.